The Federal Reserve cutting interest rates while the stock market is at all-time highs is a historically rare event, and I'll admit straight away, this usually leads to some of the best stock market returns we could find in all history. We can check this for ourselves by looking at this data table created since the 1980s. There's been a total of 10 occasions where we've had the Fed cut with the stock market at all-time highs, and we have complete time data on 8 of those occasions, and we see that we have an average of a 19% return over the next 12 months with a 100% success rate. With the age of social media and mainstream media, everybody knows this information straight away, and many people, probably institutional investors, have been investing with this in mind for the last really 3 to 6 months. And I believe that leaves us vulnerable for a bit of a stock market decline before the end of this year. All we are really waiting for is a catalyst to get that decline started, and that catalyst could be coming from the real economy not performing as well as what people expected. Today, we're looking at something very unique. Hardly anyone is talking about it, definitely not the mainstream media, and I believe this could be a secret negative that is slowly poisoning the US economy. And that source of negativity is coming from the Fed, or the central bank itself. And in order to understand how the Fed is secretly pulling the rug out from all of us, we do need to go through the 3 different ways the Fed tries to manipulate the US economy. First up, we have the Fed changing their Fed funds rate, or in other words, interest rates over a 1-day period. I'm going to assume everyone knows what this is, and the fact that we've started our interest rate cutting cycle, and that's why we've had so much positivity in the stock market. And we are likely going to see this continue with around 1.25% of rate cuts by the end of next year. And the second way is the Federal Reserve and the speeches that they give. So people like Jerome Powell and the other, I think it's 12 total governors, they come out and they tell us their thoughts on the economy. And Jerome Powell is being pretty cautious, but he's not saying we are going into a weak job cycle or maybe recession anytime soon. He's just cautious. And honestly, I don't have the biggest issue with that statement. It's more about him not 100% being honest with exactly what the Fed is doing in terms of their third way of manipulating us and the economy, which is their money flow systems. Now, the Fed has 2 different money accounts. This controls the amount of what we call liquidity entering the banking system, and in terms of government spending ability. The first money account that most people know about is the Fed's balance sheet. This is measuring the net amount of money the Fed has ever printed in order to stimulate or help give funds to the US government. The Fed prints money and then buys up US treasuries, which is effectively just loaning the US government money. When the Fed's balance sheet increases, that should be inflationary and stimulative to the US economy. That is exactly counterbalanced by something called the reverse repo facility, or the second major money account held at the Fed. The reverse repo facility, I believe, is 30 years old, but it's only really been used since the 2020s. The reverse repo is a fancy name of saying this is a spare money account which big banks can put spare cash into. They just have no way of utilizing trillions and trillions of dollars that were really printed during 2020's lockdowns. So the money that flows into the reverse repo, or spare cash, is taking money away from the economy, and this is actually deflationary or less stimulative to things like the big banks and real lending. Now that we have seen the 3 big ways the Fed manipulates us, most people, mainstream media, only talk about the first 2, but I would say the third technique the Fed has, money printing, is only talked about in the middle of a crisis, but they've been pulling the strings secretly, trying to perfectly balance inflation and growth ever since 2020. And we have one really good piece of evidence showing the Fed's words have not been matching up to their actions. Ever since 2022 and the massive inflation wave, the Fed has been saying, look, we're going to try and fight inflation, we're going to raise interest rates, we're talking harsh about inflation with our Fed speak, and they did actually delete $2.4 trillion off the Fed's balance sheet, again deleting US dollar liquidity out of existence, and it should slow down the economy. However, what they failed to mention publicly, and many people miss this, is the fact that the reverse repo actually got drained in the last 2 years about $2.4 trillion. So in effect, all of that money deletion they told us they were doing actually did nothing. And what's actually a little bit scary, and one of the big reasons I made this video, is the money deletion story. The Fed's balance sheet is still going down $30 billion every single month. However, the reverse repo has officially just hit pretty much zero. In other words, the Fed had a foot on the brake and the accelerator, and they have just taken their foot off the accelerator in terms of the economy. And we can maybe finally see what the Fed's inflation battle can do to the banking system and to lending now that this money balance has swung to the negatives. I do have a few other news pieces to talk about here. As always with the real world, things are not always positive or negative. The story is probably somewhere in the middle. The first chart I want to look at here is the US presidential cycle and the seasonality of the S&P 500. And what we are coming up to is seasonally the worst stock market period in the entire 4-year cycle. That's sort of 6 months that happens before the midterm elections. But again, investors know about this. Maybe we try and make some last minute gains in our stocks over the next 3 months, but the first half of next year is not looking that great. And we also have a very popular media story going around at the moment, which is probably scaring investors. You might have seen it, about US credit scores dropping the fastest since 2009.
All right, new this morning, new data showing that credit scores are falling at the fastest pace in the US since the Great Recession, as Americans struggle to keep up with the rising cost of living.
The problem with that story is it's just not really true. And we can look at the Fed's own data here, just simply looking at total loans and how many people are going delinquent, not paying back their loans. And we've been hovering around 2.7% now for about a year. And going back into history, I would say we're actually at a decent level. It's this low delinquency rate and it's not skyrocketing. That's giving me the confidence that we're not seeing recession really anytime soon. It's at least 6 months away. And that leads us to the last story, which supports the idea the US economy is kind of just stuck in the second, third gear. We are not seeing a red hot economy like we did maybe back in 2018, but we're not going into recession either. So the first chart to help explain this is the balance between inflation and wage growth. Yes, we did have this huge inflation wave, and I believe we were in recession because of that in 2022, and we sort of got out of it by early 2023. And that perfectly matches up when wage growth started to outpace inflation. It maybe took us a year to get over that peak, but now in 2025, we are firmly 2 years in this period of people making more money than what their baseline costs are increasing. And I do understand the idea that these are all averages. The bottom 30-40% are always going to struggle, but we have this top 60% that is spending money in the economy, investing in AI, and are actually doing pretty well. And this relationship between people affording their cost of living also shows up in their credit card debt. Now we are below long-term averages, only seeing credit card growth of around 3%. This is a healthy place to be, and hopefully people can even pay down their credit cards. But at this stage, people's wages are growing faster than credit card debt, which is a positive place to be. And to make things clear on the channel, I'm not here just to sell a positive story or a negative story every single time. I think those channels are a bit of a waste of time. I do also want to show solutions to these problems, and I do believe the stock market is still the place to invest. It's just not in the S&P 500 itself. It's more going towards individual companies. And to help explain this, we're going to look at the valuation of the different groups in the S&P 500, and then looking at individual company names and see that this story of an overvalued tech market isn't really correct, or at least in my opinion. But we go here looking at the S&P 500 forward P ratios. Yeah, we have the mega cap 7, which is basically big tech. They are above a 30 forward P ratio, traditionally very expensive. And then on the flip side, we have the S&P 500 excluding big tech, or the biggest 7. That forward P ratio has now increased to a 20. And in order to see who exactly is actually overvalued at the moment, I do think we need to look through some individual companies. And therefore, what I've done here is collect 3 companies I would say are more not traditionally minded companies. Some of them are extremely cheap. General Mills has a forward P ratio around a 13, but again, you're getting negative growth this year and low single digit growth moving forward. Probably the same for Lululemon and Kimberly-Clark. And when we compare that to big tech on the right, we have, yes, Nvidia, Google, and Eli Lilly, which is a healthcare tech company. They make basically Ozempic, but a different version. You can buy Nvidia at a forward P ratio of 39, but you're getting 50% earnings growth this year, 40% next year, and probably decent growth moving forward. And you also have Google, which I think analysts are underestimating next year, 23% earnings growth this year, probably another 23% next year. You can get that for around a forward P ratio of a 21. And that's why the solution I'm trying to peddle on this channel here is that we can make our portfolios of just our favorite individual companies, somewhere around 10 to 20 names, bit of diversification, but only picking companies that are undervalued against their decent, strong growth. If you enjoyed this video, you're probably going to enjoy these other two I have on the screen here. Make sure you subscribe if you do like this content. I hope to see you guys next time. Bye.